Okay.
Sorry, almost forgot that part. Everybody would have a pretty short YouTube video.
No worries. All right. My name is Joe Scorese. I work for FirsTrust Bank out of Allentown, Pennsylvania, via Horsham, PA, but I'm licensed in all 50 states. And we have various programs in the non-QM area where it covers residential 1 through 4, whether it is for fix and flip, fix and rent, or bridge financing, however you want to bridge it to a BRRRR strategy. We also look at current operators that have multiple properties, and we could look at a blanket type of functionality of blanketing the properties. We also have mixed use products, commercial loan products, but for the most part, and multi products, 5+ units. But for the most part, from everybody I've heard, most of us are in the 1 through 4 residential investment arena, which is fine. And I'll keep it to that level so we make sure I don't go too far out of our lane in discussion real quick. So a little background on myself. I've been a banker since 2001. I've been a licensed realtor since 1987. I've been a real estate investor in the BRRRR strategy and multifamily space since 1993. I've invested actually, obviously, in the Lehigh Valley area. That's how I met Matt, through an event that I hold, and now I sponsor another person's event up there. I'm originally from North Jersey, Kenilworth, New Jersey, and I live currently right outside of Philadelphia. And I represent various funds. There's going to be some announcements coming up pretty soon. I'll probably be picking one fund that I'm going to be representing going forward. Just one more interview, and we'll know where I land on that. But nothing will change in what we're discussing today, what I could extend to qualified borrowers. So for the most part, what I'd like to just go over is some of the worksheets that I use to evaluate properties. I'll talk about some terms and then and the criteria, and then if there's any questions. So any questions so far? No. Okay. So what we wanted to talk about is most of these loans that we're talking about, 1 through 4 residential, BRRRR strategy, fix and flip, fix and hold. We do not need to look at tax returns. We do not need to look at pay stubs. We do not need to look at W-2s or 1099s. We need to see cash in the bank in a bank statement or in some form of liquid asset account related to you, related to the transaction. Meaning you're going to have anywhere between 10 to 25% into the transaction at any given part, whether it's from the purchase side or from we need to show reserves on the refinance side as well. So, and we don't work with anybody typically under 660 credit score. Not to say that we can't, but we don't promote that. We will look at other credit score below 660, but the LTVs that we offer will change a little bit or get lower for the most part. In regards to cash reserves, when we're looking at a transaction for BRRRR strategy 1 through 4, we typically want to see a client that can put 15% into the purchase. BRRRR stands for buy, renovate, rent, refinance, and redo. So we want to make sure you have a little skin in the game on the purchase side. We'll give you 100% on the construction side or rehab side, but we definitely want to see at least 15% plus closing costs. And we want to see 6 months of reserves toward that mortgage payment based on the loan that you're requesting. And typically that's an interest-only payment. Rates range between 6.75 and 9.25, depending on your level of experience, asset type, loan amount, and your credit. And so that interest-only payment, whatever that might be based on a single-digit charge, we're looking at anywhere from $800 to $1,500, depending on the loan amount, just using a number. We're going to want to see that participation of funds in the deal, like I said, 15% typically. And we want to see 6 months of that interest payment, just to make sure you don't go into mortgage shock once we close on that construction loan or renovation loan. We definitely want to see, again, it's got to be in there for 2 months. I'm not asking for you to lock up all kinds of money for months on end, but I really want to see that you have some money into the deal. We're not using other people's money. This is a true construction loan. It's a true commercial loan. You need to have an LLC or a corporate veil set up whether it's LLC, S Corp, C Corp, or a revocable trust. So using other people's money in this situation, I'm not going to be comfortable unless that money is seasoned in your account for 2 months plus. Okay, because you're going to have a skin in the game. Nobody's come to the table paying for everything. You're going to have a little money into the deal and some responsibility, of course. Any questions so far? So in regards to the construction, rehab, the flip, or rehab to hold, typically we go up to 70% loan to value based on the completed appraised value. We typically go up to 85 to 90% loan to cost on the purchase of that subject property. And particularly we can go up to 100% on the construction rehab. Now, when it comes to new construction, if anybody's interested in doing new construction, 80, maybe 85, depending on your level of experience, but 80% loan to cost on a purchase, 100% on a construction, based on the 70% loan to value rule on the after repair value. Now, so far, I can provide also a copy of a maximum allowable offer worksheet and an and a cash flow worksheet for you to and cash flow to evaluate the property. Also, if you're going to hold the property, we are going to be able to allow the debt leverage, the loan on the back end, up to 80% loan to value based on a debt service coverage ratio of 1.2 or better on the subject property. We're not looking at the rest of your properties. We're going to want to see a schedule of your real estate owned, but we're really focusing in on the debt service coverage ratio of the specific property that you are looking to get refinanced out of the construction loan and stabilize. We do offer 5, 7, or 10 one-arm products, which have an adjustable following that with a 30-year amortization, or we extend a 30-year fixed amortized LLC loan. So nobody up in the Lehigh Valley in the area offer any more than a 5 one-arm. And Colorado, I'm sure with the local banks and some of the Harrisburg, they're all offering 5 one-arms, 20-year amortization. We're offering a full 30-year amortization fixed loan. Now, because it's a commercial loan, meaning it won't report to your credit, and you're going to file a business return and a K-1 with that LLC with those properties in it, there is a prepayment penalty of either 3-2-1 or 5-4-3-2-1 the first 3 years or first 5 years, and that's very common in the commercial arena. So if you're looking to sell the property sooner than later on a flip and just avoid the capital gains, this product, we have to have a sit down and talk about how that product's going to look and how that's going to impact your cost. But there is a prepayment on both the sides on the back end. Refinance cash out or refinance out of a construction loan, we only need 3 months of seasoning. You need to only for 3 months. Where most banks out there at 6 months to 12 months, we're 3 months. We want to stabilize. It just has to be stabilized. It doesn't even have to be rented. We're going to look at the market rent comps. We're going to look at the rental comps of the property. Even if it's not leased, we're going to do an appraisal on the back end to make sure we have that debt service match up with what you're telling us from a 1.2 or better. Any questions so far?
Yeah, I have a few, if you don't mind. So I know a few of us, like Rick Stivers and myself, we're getting more into lease to own, where we put a renter in with a separate lease option to buy. That person can typically buy from 1 to 10 years. And it sounds like in a case like that, we would not want a kind of product that could have a 1, 2, or 3 year penalty, because it's possible, although unlikely, but it is possible they could buy after 1 or 2 years. So what would you suggest in a situation like that?
Are you buying them in your name or the LLC?
It's for my case, it's an LLC inside a self-managed IRA.
So you're using a self-directed IRA as the PG?
Yeah, the self-directed IRA is the owner of the property.
Lend to that anyway, since it's a irrevocable trust setup as a self-directed IRA. So I couldn't use that. You're using like the money to kind of make money on your investments through a self-directed IRA, whether it's Camel Plan or Equity Trust or one of those organizations that are out there. So I couldn't lend to that entity anyway because there's no personal guarantor. It wouldn't work.
Okay.
There too, at the end of the day, most lease options don't go more than, usually they go up to 5 years in my experience. And most individuals, their credit is usually not in a place to be anywhere the first couple of years, even if they put a large hard deposit. And that's why they go into the lease option. So you might want to look at the 3-2-1 prepayment penalty option if you wanted to work with us. I mean, there's about a 20 basis point change in the rate. It's really not that impactful, but it's a commercial loan, and that's just all commercial loans in an LLC typically have a prepayment penalty. Otherwise, it's most likely reporting to your credit. It's not really a true commercial loan. It's kind of a hybrid, more of a Fannie Freddie / commercial loan. You know what I mean? They're just doing you the favor. You're a customer of the bank, and they're going to give you the loan in the LLC because you have money in the bank with them. They don't want to lose you as a customer. So I probably wouldn't be a fit for those deals at all.
Yeah. Okay.
That's okay. And you know what? I'm not here to match up with everybody. I'm here to kind of talk about what I do. And from a global perspective, you're going to still need to do these things either way, whether you present it to me or anybody else. So like the debt service coverage ratio worksheet, I offer that to you. So you have it. So you know how to debt service out your property, to understand the allowable debt leverage to your debt service coverage ratio. I also have if you're going to do a BRRRR strategy and want to do a renovation loan, I can provide you also a general construction template with the draw schedule that's compliant with all general construction submissions for BRRRR strategy loan scenarios. Also, if you want to get into the 5+ unit arena, I can also extend to you a cap rate evaluator from a bridge loan perspective or a stabilized loan perspective, whether you're buying a turnkey. And most of these other loans, these loans with the LLC going up to 80% loan to value, we can do turnkey. Property just needs the debt service coverage ratio 1.2 or better. That's just getting a little more difficult right now in the seller's market, which will shift over the next 6 to 12 months. The inventory will get increased due to a lot of the issues that are going on with evictions and landlording, exhausted landlording, and new landlording movement coming into the business. So does anybody have any questions? Because I can provide any of these documents for your review, for your study, or our discussion following up. But I know I only had about 10 or 15 minutes. I wanted to give you kind of the bullet points that made the most amount of sense.
Hey, Joe, this is Richard. Oh, I'm sorry. Go ahead, Brian.
Oh, no, go ahead, Richard. Your turn.
Oh, no, I just wanted to say, Joe, I for some reason, we are familiar in email because I get email from you. And I think I've sent you a few deals, but anyway, I have an opportunity where we're in tax sale season and I'm looking at tax sale properties, and I've come upon one where the gentleman has he inherited the property from his late father, and it has approximately 10 years worth of property taxes owed on it. So I offered him to pay off the property taxes and to give him money to move in exchange for the deed. Okay. And he's actually considering that. The ARV on the property is around 250, 230 to 250. But the taxes owed on it is around 60 grand. So on something like that,
70 grand, right?
Huh?
You'll be into it for about 70 grand.
I'll be into it for, yeah, about 65, 70 grand. Yeah.
Yeah, I'm just rounding up.
Right. So 70 grand in. The repairs that I saw from the outside looked to be about 10 to 15 from the outside, maybe 20, because there was a little bit of asbestos siding on a little portion of the roof. But I got to get all that evaluated. So I'm conservatively estimating about 50 grand in repair costs. So my cost basis then goes to about 120, right? So okay. 120 cost basis. What would you do in something like that? You would land on, I'm going to pay the cash for acquisition cost of the property. You would give me the money for the renovation work. Yeah.
No, too small of a deal. That wouldn't be I mean, 15, 20 grand doesn't really cost benefit me to even deploy money on that deal. So okay. You're going to be into that all yourself.
Okay.
Unless you're talking, you bought it for cash and you need my minimum loan size for construction is $75,000, or it's not even cost benefit for me to release funds. So either I would suggest getting an unsecured business line of credit in your LLC and leverage that, where it doesn't impact your credit too much, and set yourself up for an unsecured business line of credit. Buy that, because the renovation costs are small, not a lot. I mean, a lender like myself, or even a private lender,
Yeah.
they really don't have an appetite for 50 grand worth of to put the construction money out, because small loan for them. And they're, I mean, even though they're going to be in first position, because you're going to have a clean title at that point, it's not a big enough loan to be excited about. So you're almost better at using unsecured business lines of credit to leverage that, and then come back to me 3 months later and just do a full cash out based on the debt service coverage ratio of a leased out property.
Okay, yeah. I'm actually thinking of flipping it, so.
Okay, well, I mean, again, and you're
In
better
that
off
case.
using a completely unsecured business line of credit.
Yeah, I can just use my cash on it. I got
That's what I would do.
I just got 2 of them like that,
Yeah,
2 deals in play like that. And with tax sales properties, I could end up with an inventory of properties where I need to do something like that. They all will be too small, but collectively, they might be worth your time.
okay.
If I were to package these into a portfolio, is there any possibilities there?
So repeat that question again.
If I got multiple properties that I've already done the due diligence and packaged them into a number of properties in a given area, and they all need renovation, and I have my portion of the skin in the game, either through mostly through cash, and all I would need would be money to renovate those properties. Would you play in a game like that where you have multiple properties under one transaction?
Yeah, I mean, I would have to look at the loan size per property. And I could either set up a construction revolving line of credit to do that per
Okay.
transaction. But again, it's going to be depending on loan size per deal.
Okay. All right. Well, we can talk about it offline.
Yeah,
Thanks.
absolutely. It would definitely be case by case.
Hey, Joe, I think Ryan has a question for you.
Sure, go ahead.
I just have a quick question. You mentioned you need 6 months of expenses to cover the loan. If I had the money in a mutual fund or 401k plan, would that qualify to cover those expenses?
Yes, it would.
Okay.
You also mentioned that we need to have, let's say, 20% skin in the game, but cash on hand for 2 months. But if you have a HELOC, do you have to pull money out of the HELOC 2 months in advance, or showing you the HELOC good enough?
I like that first part. The HELOC technically is not your money. It's leaned against the house. So technically it's the house's money, not yours. So taking that out of the HELOC would be highly suggestive. And that cost would be incurred by you to put that into an account to let it sit there for 2 months. I've had the same situation where a gentleman wanted to buy 15 properties up in Norristown, Pennsylvania, right? And it was like, I just easy numbers. It was $1.5 million and he needed $250,000 for the deal. He goes, well, I'll just take it out on my line of credit. So you don't have the physical cash in an account? He goes, no, it's in a line of credit. I said, well, then technically it's not your money. It's the leverage of your property. So, I mean, you have to be very careful with using a line of credit. You definitely want to show the liquidity. Okay.
Yep.
And anybody would like any of the sheets that I use to evaluate the property, by all means, please send me shoot me an email and I could send you the documents to better evaluate these properties to put yourself in play for evaluating deals such as BRRRR strategy, single family through 4 family. So my email is up above there. I did put it in there, my email and my phone number. If there's any questions, we could go offline and you could privately call me for a consultation to discuss your scenario. I see Scott said, yeah, please email me, but my email's above. It's joseph@josephscorese.com, or my number is 215-290-5108. Is there any other questions? Because I know you guys are on a schedule.
No, Joe, that was awesome. Thanks so much for the info. I know, guys, Joe, he's a great guy. He has a lot of experience and he's been in this for a long time. If you have any any of the needs that might fit the subjects he just talked about, please feel free to reach out to him or any of us. I know Richard's already talked to him about some things, but he'll definitely hook you up. So
Thank you very much, gentlemen. Be well, take care of yourself. And if there's anything, like I said, my phone number, my email's up in the chat box, and everybody have a great week.
thanks, Joe.
Thanks, Joe. Take care.
Take care.
All right, guys. We got everybody still? All right, so Joe is no longer on the call. I just want to give you a quick background on him. I met him at a local meetup about 3 months ago. I do not know him very well, but I do know that he has quite a reputation in the business as a lender. He has quite a unique job right now, and they have it's kind of crazy they can even do this. However, banks have certain lending restrictions, and they need loans in all portions of the country, demographics, people type, employment type, and they're targeting minority loans right now as far as people are concerned, because they are trying to encourage minorities and people who otherwise could not find loans to buy property, not in a negative way, but they're trying to give people of all backgrounds some pretty crazy rates. And if you know of anybody in the area or anywhere out that has anything other than the standard, this is going to sound.
Matt,
what's up, Richard?
Matt, you're telling me that you just said that there's offerings for minority loans, right?
Specifically, the ones that he told me about.
Yeah.
Pennsylvania, for Latino Spanish descent, they are willing to work with significant values and up to, I think he said, 1 to 2% out of pocket for these loan products. Now,
but I can't. But you can't get it because you're white, and I can't get it because I'm black. That's racist, man.
Well, there's various forms of these loans out there, and they have special programs. I completely agree with you, right? I completely.
All right, we need to stop this nonsense. Okay, give me the loan the same way you would give it to anybody else.
Richard, it's okay. I identify as Hispanic, so I think I'll qualify.
Yeah, you knew I was going to jump all over that. Oh my goodness.
You could pull many loans out of a hat, including the VA.
His email doesn't look right. He's got Joseph at josephvscorese.com. I think there's an extra Joseph at in there.
Yeah, I think Matt, Joe's seriously though, I think Joe's lending services are going to be more towards the larger deal typically. Okay. I gave him a scenario of the one deal that you guys heard about with that property that's a tax sale property. Again, we're in tax sale season. That's just another avenue that that we can look at to acquire inventory now, in an inventory starved environment right now. But I also gave him the scenario of multiple properties where I have an opportunity to say buy multiple tax sale properties. Then I own them outright. I have that equity there, and now I want to borrow against it in order to repair them and then maybe flip them, rent them, do whatever I want with them. But he doesn't play in that either, or he says case by case, which is a different answer than I would have expected. So it sounds to me like we really need to have something in the $500 to $1 million range before we can kind of pique his interest in the area. Does that sound about right to you?
Yeah, and I was talking with Ryan offline about that before, because Ryan's looking at a deal right now that's like 3.5, and it wouldn't be his ideal product. Where Joe's products really excel are the construction renovation loans and bigger deals. So if you have, a loan to buy a property for $100,000, you need to 203K it, and your ultimate budget's going to be like $200,000. He would be a really good resource for that. They do a lot of that. And they do have a lot of renovation and rehab style loans. However, when it comes to multifamily investment, his restrictions to getting in are higher. You need higher down payments, more reserves, like Ryan asked about. But they have really, really good programs when you get above the $500,000 range, because then it's not really based on your background, your assets, and your income. It's based on the property and its performance. So if you go after a 10-unit building, Joe's not going to look at Matt's income anymore. He's going to look at rent rolls, all of the expenses.
Well, that's typical of a commercial deal, and I've gone through that. In fact, that was the first deal I went through with that $1.2 million portfolio. It's all about the debt coverage ratio, guys. It's, you know, that debt coverage ratio, if it's 1.2 or higher with any institution, not just Joe's mortgage lending, but with any bank, the baseline is 1.2 for the DSCR. That's the debt coverage ratio, and that's basically a measure of how much of the deal, income from the deal, can support the debt service of the deal. And that's going to be at 1.2 or higher, and the higher the better, less the cost of renovations and things like that. So yeah, and I think, Matt, from your deal, the one you did with your multifamily and commercial, yours was, your DSCR was somewhere around 1.3, 1.4, right?
Now it's 2.1.
Oh, you're killing it. You're killing it. Wow.
But yes, the bank is going to want to see a minimum of 1.2 debt coverage ratio to make sure that
absolutely
they can be certified, you know, okay, that this thing is going to cover everything it needs to cover.
Right.
So yeah, but Joe, he's a good guy. Reach out to him if you have any questions. Lots of good resources there. I have not personally used him for anything yet, but I figure it was a good way to introduce him to the group. If you guys have any needs, he does run kind of everywhere. So I wanted you to meet him, talk through it, but I want to really get into our next section here. I know Scott, I'll do a quick little blurb about Scott. If you sense any resemblance on the screen, yes, we are related. In fact, he looks almost identical to my brother, and he lives pretty far away down in Atlanta. He's been killing it in real estate, and he's kind of like the main guy for this meetup. And I'm really excited to have him introduce himself and talk to you guys about this. And hopefully you guys can learn something from his experience and his investments. And he'll have a really awesome story to share, and hopefully everyone get something from it. So Scott, thanks again for joining in. I really look forward to hearing about it.
Glad to be here. Thanks, Matt. Yeah, I think the main resemblance is the schnoz. We got, you know, nice big noses, the Italian noses. I have no idea why he invited me to be here, because you guys are probably so far more advanced than I am in real estate, and I'm pretty much just a big hack. Whenever Matt asked me to send in a little bio, I'm like, well, I guess I'm a serial entrepreneur. I'm not real sure what I could say that I am, but 43, I'm married, I've been married 22 years. Have an 8-year-old daughter, so it took us a while to have her, but she's a major blessing. And yes, I live just outside of Atlanta, Georgia, in a little town called Social Circle, which is great because I'm a social person. I love hanging out with folks and talking with folks. And I've been doing residential real estate since 1999. Bought my first house. Bought it from my grandfather, which was really nice. Started reading a little book called Rich Dad, Poor Dad. You guys have probably never heard of that one. Millionaire Real Estate Investor, got in on that. Good to Great, 7 Habits to Highly Effective Business Relationships, and just really started getting after it. I started my first business at 17, which is music, which is what I do primarily right now. Then I started a pressure washing company doing residential work. Then I moved to more commercial flat work, joining with some builders, which actually kind of got me some ins to properties. And I decided I was going to leverage my equity in my first house. We did a renovation there and leveraged the equity there, bought another house and started the rental thing, which I guess, how many of you guys are doing residential right now? Show of hands. Okay, I see one. Maybe some of the others are on there too. Yeah, so started doing that. This quick little rundown, so you can stop me in here if I'm getting too much into this. Matt, I know you're the host. Bought my first house, and I decided I would live in it for a couple of years, then rent it out, try to avoid those capital gains. At that point, that was the rule. Now you have to actually live in it the last 2 years before you sell. So lived in that house for another 3 years. This was around '04, whenever the gas prices were ridiculous here in the States. And I decided to move to Atlanta, where my wife graduated, got a job at an architectural firm, and we bought 2 houses on the same day in downtown Atlanta. Don't ask me how, because I was a full-time, what I call musicianary at that point, pretty much going on stated income. You guys probably remember those days, where pretty much if you have a social security number, they would give you a loan. And they did. They gave me 2 loans on 2 properties, bought one for $230 and one for $295 the same day. Crazy. So the one house that we bought in Atlanta actually had it already had tenants in it from Georgia Tech down here, which was a nice score. We bought the primary that we lived in, the second one, and eventually bought another house. It was a foreclosure up in the Kennesaw area, just north of Atlanta. And that was 5 at that point. Eventually moved out of my Atlanta house, and crazy, I moved into a 2-bedroom condo, and I rented this 2-bedroom condo while I was owning 5 rentals. Never thought I would do this, but it helped us to get out of college debt. We saved money to have a family. We got completely out of debt. So now we've been 100% debt free for 8 years now. Thank you, Dave Ramsey. He was awesome. If you haven't checked out Dave Ramsey's products, I'd love to tell you something about those, but moved out to Social Circle. And as of 2 years ago, we had 6 properties. Recently, we have sold all but 2 of them. And now we're just looking to do some new investing. I've got some creative ideas that I'm looking for property on, and trying to decide what's next. So that's a really quick overview of what's been going on. And I could take questions and we could talk more about the details of those if you wanted to know. But you guys will probably have a lot of information from me. I'm already learning a lot just listening to you.
Scott, when you say you're debt free, is that personal debt, or do you still leverage your real estate investments?
So I owe $28,000 on one house. Everything else is debt free. I own my home that I live in. Bought my house here in Social Circle. This is crazy. Out here in the middle of nowhere. I moved from downtown Atlanta, where you could high five your neighbors out of your window, to Social Circle with 6 acres and a creek. It's like being in the mountains. Bought this house for $118,000. Crazy. It's worth like $350 right now. Of course, everything is worth $350 right now, but it's been a blessing. It really has, to be able to do it and to continue to have my renters pay down my mortgages. And then obviously selling has been huge, just trying to sell at the right time. A couple of them I would have done better on if I would have held them to this year, obviously. But we were glad to be able to carry it through.
So Scott, we have guys in this forum right now, everybody from just starting the beginning interest, the whole reading the book for the first time, all the way up to guys who are, crushing it with portfolios. And, you're way too modest for your accomplishments, because the stuff you were talking about is fantastic. And I know when we met last year, you're killing it down there. And one of the things I wanted to see if you could help emphasize to these guys is, there were obviously very difficult times, whether it be family, social, economy, all these different things. But what were the things that you did the same with all these deals? You probably didn't feel like you were even doing a deal at the time. Mm-hmm. And now you look back on it 15, 20 years later, and you have this awesome thing going for you. But what's some advice you give to these guys who are getting started and have some questions about it on a bigger level?
Man, so this was 1999 when I bought my first deal. The rules change all the time, but just learning. I think what you're doing, Matt, what you guys are doing, meeting and having shoulders to rub on and talk back and forth and having all of this dialogue. I didn't have any of that. So this is huge. you guys have each other. I would say first and foremost, man, look, we need each other. If you're alone, it's going to be way harder. So having this group is huge. I just commend you for doing that. I wish I was able to jump onto some of the earlier ones, and I'm going to try to get in on more some of the ones that are coming up. But yeah, partnering with people is huge. I didn't have a real estate mentor. I tried to glean as much as I could. I would take people out and sit them down for lunches and dinners and try to just learn the business. The biggest thing I could say that worked for me, I had a good friend of mine whose mom was in the court systems, and early on, so I'm in ministry. I work at a church. I'm a musicianary is what I call myself. I like to leverage my resources for the greater good. And my first rental, man, I was just getting taken big time, and I was being way too lenient. I would listen to all the sob stories from my tenants. Some of them were true. And this lady who was a judge, she said, listen, man, you can't handle this business like a ministry, because if you do, you're going to take your whole family down. She said, you've got to handle it like a business. And if you can't separate the two, you got to be kind to people. You have to treat people well. But if you can't separate the two, you've got to get out. And so I had to really consider that. Do I want to stay? Am I going to keep doing this? And she helped me kind of set up some boundaries, so that's whenever I set up officially my LLC. It became England Management, and I became the property manager, which was truth. I was the property manager. I was no longer representing as the owner. And so at this point, my wife and I were technically owners, because we would go in back and forth, and depending on who's getting the loans. And so I would represent the owners. We're a small family owned business, which is completely true. And at this point, I was able to just go in and say, look, I understand your needs. I understand your limitations. Let me take it back, and we'll talk and see what we can do and see how we can help you. And that usually kind of cut it in half. Any kind of discrepancies that may be not mutually beneficial, those would go away pretty quickly. Even to be able to say, look, here's the deal. We all have issues. We all have problems. I see you have a brand new car out there, but you aren't able to pay your rent. So I don't get to live for free. You don't get to live for free. Basically, what happens is if you don't pay your rent on time, there's an automatic dispossessory that gets filed. And you guys are probably pros at all this stuff by now. But that was the big one right out the gate. Just being in communication, trying to help when I can, but also making it clear that this is a business. I'm going to take care of the property. I'm going to make sure that everything is 100% for you, and you're going to pay on time. There was occasionally I would let people go because I knew that their situations were legitimate, 10 days. But that's it. Because in Georgia, they can sit there for 90 days. By the time you give them the 30 days, then you file the dispossessory, then you're able to get them out of there. It's 90 days. And that actually happened to me once. So I ended up having to evict someone, and it cost me about $7,000 by the time I was all said and done. So the rent was $1,500 a month, and it was a legitimate story. And the guy ended up showing he just left his family. He was gone. They couldn't find him. So after about $5,000 worth of back rent and me trying to take care of these people, finally we went after them and had to evict them. It was one of the saddest things I ever had to do, because their family still couldn't find the guy. But gotta do what you gotta do.
I saw an article a couple of days ago about a guy in New York that's been in a house 21 years and has not made a payment in 21 years. I think it's bank owned, and he inherited the house. The headline said not paid rent, but I think actually he's got a good lawyer, and they just keep filing and filing, and COVID now. But another good thing I've heard is, and it's the truth, when somebody wants something like that, you just say, listen, I rent to multiple people, or my management company rents to multiple people. And we have to be very careful that we treat everyone the same. The law is the law. So if I make an exception for you and I don't make an exception for somebody else, then I could be considered as being discriminatory. And I can't allow that to happen to my company.
That's
And
good.
so you just blame it on the system. Look,
Yeah.
I'd like to help you out, but I can't. I have to treat everyone the same. And the other guy that comes to me with a similar story might not be telling the truth. And if I figure that out and I treat him differently than you, now I'm in trouble.
Mhm. Absolutely. And you find case by case basis, you can tell when people are being legitimate, and you can extend a favor if you need to. And if you trust them, if they've shown that they're going to pay. And I've done that. I've got one tenant, the house that I still own as a rental. She's been in there for 15 years now. She's paid on time every single month.
Yeah. So let me
Huge.
get back to your debt free, because I'm fascinated by that, because even though you've been investing for 20 some years, there's different schools of thought around that. Some people, I've gone through the Dave Ramsey stuff and I understand the benefit of being debt free, but if you're going to ramp up a real estate business, you can obviously do it much faster with leverage,
Mhm.
especially if you're starting out. If you have enough money to buy one house, if I had to pay cash for that house, most people would never get into real estate investing.
Mhm.
And obviously you took out loans, but you paid them off pretty quick. So I'm guessing maybe you had 15 or 20-year loans and you paid extra based on the rent coming in and you just paid them down as fast as you could. But what was your story? How did you get from being leveraged to being debt free? And how does that parlay into your desire to ramp and scale up your business?
The easiest way is I sold a lot of properties, so that helped. And then obviously we made money over the years. So I always tried to make sure while I was doing my calculations that I would be able to get at least $300 over and above what the mortgage was going to be. Early on, I used that money to buy my other house in Atlanta, and I was actually foolish. I decided, well, hey, if I've got an extra $400 coming in and I could still take care of my repairs, I could put that towards my own personal house. Now I can basically overextend myself and be house poor. And that was not smart. And I learned a lot of lessons. That was the same season where 2008, the economy was tanking. People were upside down in their houses. I was in a house I shouldn't have been in. It was way too much money. That was the same year I was doing that eviction. And I was trying to figure out how I was going to pay a $2,000 mortgage and a $1,500 back rent all at one time while I was full-time doing music, living week to week. And my wife was in school and waiting tables. So it was crazy town. And that's when everything changed for me, when I realized, man, I've got to be smarter. I've got to learn how to live well below my means. And I can't operate and function in debt when I have all of these bills that I'm trying to pay, because I could have lost everything right then and there. So that got me on the course to getting out. And that's why I moved into that condo. Of course, we didn't have children at that point, or child. But the main focus was get rid of school debt, pay down that debt from the eviction, pay down any additional debt that I may have had. We paid off our vehicles. We still have the same vehicles. I'm driving a 1997 4Runner and a 2004 Expedition. Just doing it, man. And the reason why I went after this thing in the beginning anyway was knowing the career path that I chose, I wasn't going to be able to make a ton of money, more than likely. So I started with just trying to get my debt to income down and making sure that I had no personal debt. Definitely not against taking out loans, and I would probably need to do that again. In fact, moving forward, I'm going to probably need to take out some loans to do anything else creative, unless I just happen into something amazing, which is a possibility. But Did that answer the question?
Yeah, I think so. You know, it sounds like you really focused on paying off what I would call bad debt, which is debt that costs you money,
Sure,
you know, ahead of your good debt, which is debt that makes you money.
sure.
Some real estate philosophers like myself, I gravitate toward deals that I know I can do on a 15 or 20-year loan, but I'm 58 years old, right? So I'm probably in a different place than some other guys on the call. You know, I have a short runway for those of you pilots out there, right? You know, I don't have the luxury of 30 or 40 more years to build it up. So I'm really focused on short term, you know, really high cash flow, you know, kind of stuff. But there are other investors who not only would say a 30-year loan, but if they could get an interest only loan that is perpetual, they would do it because of the decreasing value of money over time. So you buy a house for $250,000 today, even if you only paid interest 30 years from now, you still owe $250,000, but that's like $100,000 today because the value of money decreases over time. So they'll take that current cash flow ahead of future payoff every time. I'm not quite that extreme because, you know, I don't want to be $2 million in debt 30 years from now if I'm still alive. But it's a philosophical thing. So I'm just kind of curious. It seems like your philosophy is you love that low debt, you know, thing. But if you really want to scale up, you need to leverage your business.
Yeah, and I might be there. You know, that might be the next move. When I started this, I was in my early 20s. I had no idea what I was doing. All I knew was I liked the idea of having rental properties, and my goal was to create a business that would give me a retirement. You know, I probably would never have a good 401k. Being in ministry, I'm not going to have a ton of benefits. That kind of thing. So I was trying to think creatively. If I'm going to do music the rest of my life and support my family and set up my family for something, I want to have a really nice portfolio at the end of it. So my goal was establish a bunch of properties, have my tenants pay them down, and then in 30 years, I've got something substantial coming in. This cash flow is going to be substantial. So that was my initial goal. And, you know, fast forward 20 years later, where I am in life, my goals have changed a little bit. I know that I still need that nest egg for retirement. But we're looking to potentially move that elsewhere. The other thing is all these properties were in the perimeter of Atlanta, and some of them a little bit above. I'm way out here. I'm on the east side of Atlanta, you know, 2 hours away from some of these properties. So I'm no longer the property manager. I'm not able to get out there and do these repairs myself even anymore. So now, you know, my income is drastically changing, right? So I decided, am I going to keep going down this road? And the way it was working, people were just, they wouldn't stop calling me. They wanted the properties, right? A couple of them were in not the best parts of town. So it was a great time to unload those. And so I kind of just started shifting, being out here, going, okay, I want to have a pot of money that I can consider what's next with, you know. And so I'm even thinking now, I'm looking for advice on what to do with it now and how to best leverage those resources too for the future. So I'm kind of at a new game. And Brian, I think, you know, just looking at where you are, how old did you say you were? 50?
I'm 58.
58. Okay. So you got a decade and a half on me, which is amazing. This is what I love about this group right here. You guys, there's so much wisdom in this group, so much to learn, no matter where you are in it. I'm looking for the next thing. So with me, I'm an artist, so you know, I'm into all kinds of things. I've always got all kinds of ideas going and creativity going. I'm probably less intentional with a lot of the things that I do or have done, especially in my 20s, than you guys are. So here I am with that. I will say this. One thing that I learned, Matt, you asked the question for those that are just getting in on this thing. One of the main things that I learned was the only thing worse than no renter is a bad renter. I learned that early on. And so Man, I would send everybody that would send in an application. I would just start weeding them out by sending them through tenant verification, figuring out who's going to be the best renter, and I would call every one of the people that they put down as references, and just use intuition to try to figure out, who these people are. Are they going to be a solid fit? What does their history look like? And sometimes I would sit for a month, 2 months, 3 months, and I would wait that joker out, because I would much rather be out $1,500 and have a 15-year tenant that pays every single month. So that was some of the best advice that I got early on.
Yeah, another thing is, if you have a house that might rent for $1,500 a month, you might put $1,400 and get a lot of applicants, and be happy to get $100 less than to put it at 15 or 16 and only have 1 or 2 viable applicants, both of which are questionable.
Yes, and then even maybe you raise your deposit. You guys probably know this, but if your rent's $1,500, you don't want your deposit to be $1,500. You got to give them some skin in the game. You raise it to $2,000 as my deposit. So then at the end of it, they're not going, well, can't you just keep my deposit? They want that money back, right?
Brian, that's a great point. But Ryan and I were just talking about this, evaluating one of his properties that we're hopefully going to get under contract next week. Having a tenant in place that's bad is worse than having a tenant that doesn't exist. And Scott, to your point before, how much was it? $7,000 in fees to get someone out? I mean, you don't want to take just someone to fill the rent, because you could go through that and you don't know who these people are. And there's different schools of thought to renting to friends and family, and how that can go bad in so many different directions. But some people like it. Ryan's looking at a place right now. He has 2 tenants. One is long-term. They both have solid careers. They take care of the property, and you get FaceTime and you meet these people. That's worth a lot in the grand scheme of things. Because if you have to replace them, you don't know who you're going to get. If you have to go to Craigslist, Facebook Marketplace, or Zillow, we've had a lot of good luck with Zillow leads for vacancies, because you could pick, you do the credit report, do the whole thing. But whatever you do, Scott, you hit it right on the head. Call every reference, talk to everybody you can. Facebook, stalk the shit out of these people. Megan's Law, Google, anything you can find, and try and figure out who these people are, because you want to know. Facebook profile pictures tell a lot. And it's not that you're, not renting to some people. You're doing your research. And as a business owner, you want to make sure they're going to take care of your property. And that advice you got in the beginning, Scott, from the judge was fantastic. That's like one of those things you want to, one piece from this whole meetup, that advice was fantastic. You need to separate it from the beginning, have your do's and your don'ts, and don't compromise, because that's where they take a little, and don't be always available. Don't reply right away, but be responsive if there's something serious. Mm-hmm. That's a lot of great info. Nice job.
I like how you said, I missed kind of some of the end. I guess my internet froze up, but meeting them face to face. I think that's huge. It's easy to get lazy. It's easy to get kind of desperate sometimes, going, man, I got to get somebody in there, because I can't be sitting here. But meeting them face to face, looking them in the eye, especially if you have any kind of discernment at all, it usually helps. And for them to see that there's a real person, that this isn't just some random company. One of the things I feel like really has worked in my favor is being able to say, we're a small family business. My family's involved in this. We want to take care of your family. We want you to have the best rental experience that you can have as well. This is going to be your home. We want you to take care of it like it's your home. Those kinds of things, and just seeing how they respond, that kind of dialogue has been huge. There have been times when everything lined up, but I just, I didn't get the right feeling about these guys. They didn't look me in the eye or something, and I would have to choose someone else over them. So I don't know how that works with commercial stuff. I haven't dabbled in the commercial side, but when it comes to residential and you're dealing with people, real people, man, you hit the nail on the head, Matt. Meet them, be there, make sure that they see a face with a face. Some people they shy away from that because they don't want them to know them, or they want to remain anonymous. Maybe that works better as the management company, because they're going to see me, they're going to hear from me, they're going to see me sending out contractors, subcontractors. So maybe it works better that way than if you're coming at it as the owner, who has the leverage to get them out or something. Hey, Connor.
Hey, sorry.
See your face.
Yeah.
His name's Rick. That's his kid's iPad.
Oh, that's awesome.
So Scott,
Right.
Rick had actually presented last month, doing a whole bunch of information on tax sale. And he's in central Pennsylvania, kind of out in the sticks. And he has quite a story. When I get the video uploaded, you should watch it. It's pretty unique. It's a different form of investing than we're talking about now, but he's killing it out that way. So he's
Excellent.
pretty sweet one. Does anybody have any specific questions for Scott about the stuff that we talked about? I know there's a lot of information.
Yeah. So I know the one big thing is, going through that time period of 08 and 09, was Atlanta not hit as bad as other locations? Because what I've heard is it's, California, Florida, and Detroit were like the three big ones, like, because, if you're leveraged, that would have been, and you had a vacancy with only 4 or 5 properties, that could have been pretty devastating. And so how did you make it through 08 and 09? Was it just the fact that you were debt free at that time, or, were they not over leveraged?
Man, we were not debt free at that time. That's when we started deciding, we've got to make it happen. And we took some drastic measures. It was a lot of reeling in of the pride to leave this really nice house in Atlanta. Good size house. I built a studio in the basement, and I left that for a 2-bedroom condo after 12, 13 years of marriage, and having these homes. It was a blow. It was a little bit of a blow to the ego, but that's when you got to put the big boy pants on and just get after it. That's what I had to do. But man, I'm not sure how much to share about this kind of thing, but a lot of prayer. I really felt like I was blessed to have a lot of doors open for me that allowed me to do that. So this condo that I was living in, they could have rented it for $1,200 a month. I was living in it for $700 a month, including utilities. So that was huge. Immediately, I was having $500-$600 a month. I was able to just put towards debt. We were trying to sell the house that I was in, but there's no way, because in 08, we were already upside down $75,000. Right. My goal was to live in it 5 years, sell it, have $75,000 to put cash into a new place. Right. And eventually own my home debt free. I was having no bites. I was feeling like I was drowning. Honestly, it was tough. Again, I was living week to week as far as money goes, and my wife was living off of tips from a restaurant. So it was cray town, 100%. And I ended up getting this transfer. I put it all over Craigslist at that time, was the hugest thing. Facebook. I put it in Postlets, Zillow. I was listing this thing in Kmart, everywhere. It didn't matter. I was going to list this thing wherever I could. And I ended up getting this doctor. He was transferring from Louisiana, and he was working in Atlanta at one of the hospitals in Atlanta. And he fell in love with our place. And I ended up renting to him for $50 less than my mortgage was, $1,850. And man, that saved the day. Actually, I forgot to tell you this part. So what I did, I rented that house in Atlanta, which I was house poor in. I moved into the house in Douglasville where I evicted the guy first. And I lived there for a year and a half, and I renovated that house while I lived there. And then I found a really great renter, and then I moved into that condo. And so I had both of those places on lock. And it took me, a year and a half. So 2009, almost 2010. But that was a hard time. That was a super hard season. And I didn't have this wonderful job where I was making six figures, or any kind of 401k to lean on or to take anything out of. I had zero savings. I was in debt. Right. So, man, I just really feel like it was a gift from God. I feel like everything that lined up was on purpose. And like I said, put the big boy pants on and get after it. And we just wrote it out. And thank God we were able to make it work.
Yeah, thanks. Yeah, because that's always the telltale is those that made it through that. And I guess, I'm in the same, I had one house or one rental at that time. And it was the same situation. You couldn't sell it.
Yeah.
And so, but
again, having this group, there's a lot of wisdom here to lean on. I wish I had a group like this to go, guys, what do I do? This is crazy. Let's get creative. Help me out. And so I was super blessed to have some folks around me that I would just seek them out and go, give me some answers. There wasn't Zoom back then, barely Skype. And that wasn't the thing to do.
Scott, did you keep all your locations or all your properties close to you, or did you? I know that area was a good area as far as affordability. I'm in Colorado where you can't find a 2-bedroom, 1-bath for less than $500,000, and was wondering, did you branch off into areas where it was more affordable and then just secure a property manager for the distance properties, or did you keep everything close?
My first 3 properties I bought in places that I wanted to live. Millionaire real estate investor will say buy it right. You gotta buy it right. And I was probably in the middle ground of buying it right. At that point, I didn't just snag something up that was amazing, right? So what I did, I tried to keep everything within 20 miles initially. The first branch out was just because I was living in a 2-bedroom, 1-bath house. Is the first one that I purchased, and we needed to expand for various reasons. So we were trying to find something affordable within 20 miles that would give us more square footage, and that's where we went there. The third house that I bought, actually third and fourth on the same day. The first one was the one that I was describing, living in Atlanta, being house poor in. The other one I bought in Georgia Tech with the tenants in. That was a buyer right situation. And during that season, it was market value, $230,000. I had 3 loans on that property. So I had an interest loan. I had 2 interest only loans and a standard. So they did 80-10-10 basically, because I'd already leveraged all of my money to buy my primary residence. That one was a buy it right situation, both in Atlanta. So we're still within those 20 miles. The next one that I bought was, I think 30 miles north of the city, but I bought it a mile from a major university. So my goal was I should be able to rent this one out pretty easy because it's close. And it turned into being one of the biggest universities in Georgia now, Kennesaw State University. It was a college when I was there attending. But that was a foreclosure that I purchased that one on. So it was kind of one of those situations where it was a little bit risky, but I wanted to try to expand a little bit and just see what happens, and it turned out to be a great rental. It was always rented. The issue was for me, and maybe this might be some decent advice now that I'm thinking about it, these houses were all so big. They were too big. And every time I turned one over, you've got to paint the whole thing. You have to clean all the carpets. You got to get it looking and being presentable. And so after that, I just decided, no, man, I'm going to start buying these 3-2s. brick ranches, something that's easily maintained. And when I do have to turn them over, and I don't have, a family upstairs and a family downstairs that wasn't quite on the lease, that they just happened to, they weren't just visiting for the weekend, they were really there for the long haul, those kinds of things. And I think that's what got that became super challenging living an hour outside of the city now, in hindsight, I never saw myself moving outside that far outside of the city. So now I'm looking to potentially do that here, kind of rebuild my portfolio here. But as you guys are well aware, this is not the time to buy unless you can get hooked up with something and you're able to find something good. So I'm just kind of sitting now waiting on either the next turn in the real estate economy or a good deal, or even like Matt's doing, just sending a letter out to every grandma and mom and aunt and uncle and auntie and brother and sister, and they possibly can, to try to find some new places.
Thank you.
Scott, one question for you. I'm sure at some point in the last 22 years, you hit a point where you were like, is this really right for me? Or is a challenging time, something bad happened, or really poor situation, whether it's that eviction or not. There's always like a turning point in everybody's, career where they try and see if it's something they want to keep doing. Did you have any rough patches? And if so, what did you do to kind of push through it? And you didn't have a choice because you don't have a career that supports your family in a whole outside of all this, is all kind of growing organically. But what's your experience there?
That's a good question. I think that 08 season was definitely the toughest season that I ever had. I learned a lot. I shifted quickly. I made the sacrifices that I need to make to get myself in a better position. After that, I would say the distance, that was the biggest thing. And this is something I've gone through just recently. In fact, I sold that second Atlanta house that I bought for $230 at Georgia Tech. I just sold that in February. So I put 100,000 cash into it. I owed 140 on it, and I sold it for 550. I think it's worth like 590 right now, 2 months later. But anyway, I did what I did. The idea was, it's time to look in a different direction and come about it in a different way. So I'm at a point in my life at 43 going, okay, I just opened up my first Roth IRA this year. Right. And most of you guys are probably well past this. You have 401k, you have a Roth. I was listening to Brian talk about some of his investments in his portfolio. So now I'm kind of sitting on this kind of nest egg of cash going, what's next? Almost at a start over point, because again, I've sold all but two: my primary residence, which I own debt free, and my first rental that I ever bought, which I owe like $20,000 on now. I'll probably pay that off soon. But now what? And this is truly one of the most questionable moments where I'm going, okay, what's next? What do I do next? How do I invest next? Do I get into commercial stuff? Do I try to buy some units with multi-unit sites here? I've got a vision of doing this kind of tiny home spot, a getaway-ish kind of idea. I think I shared this with you, Matt. I've been looking at properties there. I've been digging a lot, trying to figure out what I can do in this season. And, I would say this is side B. This is the next challenge. This is the next part. What do you do now? Because there's sometimes I doubt, well, man, should I have sold all these things? Should I just be holding on to them? Because originally I was in it for the long haul. I was in it for that 30 years when you pay them all off and you've got all that cash flow. But considering other options and other avenues, short-term rentals are huge right now. Looking at getting an Airstream. I bought an RV and I was traveling and touring in that, sold it. Now I've got money there. Thinking of putting an Airstream on my property, doing some short-term rentals there. I'm looking at doing like a tiny home spot where I can help people to get away and kind of have have a break from the monotony and the craziness and get some mental clarity and have some time to refresh and plan and really figure out who they are in this season of life, and just a lot of creative ideas that way. So I'm sitting on it, but it is a challenge because some of it is a lot of who I am as far as an entrepreneur was wrapped up in all those properties and having, my net worth. That is the only thing that was really worth anything at that point. So now I've sold them all, most of them. So yeah, hope that answers that.
It does. You went full cycle here. You went from in the beginning learning house hacking, essentially from house to house to house, accumulating portfolio, and now you've all but liquidated. And you and Richard are almost in a very similar spot where he had 4 units that he just sold in the last few months, and he's starting over, but he's starting over to scale up because you guys don't have any steady source income that supports the family outside of this. This is like what is going to support your retirement.
Mm-hmm.
You have all these different options, and it's a cool spot to be in, but it's also a very dynamic real estate market to be plunging into a new different style of investing. So I think that, are you locked into a certain geography with where these investments have to be, or for the right investment, would you venture outside of the South?
Well, my idea there, Matt, would be to get me some of them there flippers. And yeah, I'd love to do a flip. I've been looking for some flips. In fact, we almost bought 2 of them in the last 3 months, but people are just willing to pay crazy amounts of money for these houses. And I'm not looking to make $5,000 in 3 months. None of us are, right? So if it was right, I would definitely venture outside of Georgia to do a flip and to make some additional equity that I could invest elsewhere. It would kind of need to be the right thing. So, with building materials so crazy high and everybody willing to pay 20-30% more than what the place is actually worth, I've just been sitting since February. Just been sitting and keeping my eye open, talking to people, trying to decide what's next. So have you guys been kind of experiencing the same thing? Have you been kind of hitting walls, trying to acquire new places? I'd love to hear some of your thoughts on that and what you guys are thinking creatively as what's next.
Yeah, this is Richard. I would say, yeah, there's definitely been a wall in terms of being able to acquire properties that are investment grade. At least in central Pennsylvania here, we sold, as Matt mentioned, properties in Harrisburg, and I just made crazy money on them. And that's after running them for a couple of years. Yes, I did have one bad tenant, but it still didn't. My net outcome for that property was still positive, and we benefited. So all that said, though, that's one of the reasons why I started. I've been going to auctions quite often lately, both sheriff sale, which is foreclosures, tax sale, which is the courthouses. And I think that with the moratoriums ending, we're going to start seeing more of those inventories come on. And that's really where I'm looking. The MLS doesn't have anything. I mean, yeah, there's a few properties that are bank owned that went through the foreclosure process again, but we're not seeing enough of those properties for investors to really take advantage of. And once banks list a property, they don't tend to discount it the first 30 or 60 days. They'll discount it after that, maybe in terms of looking at other offers, but everything in terms of what's out there now is really tough. The property that I mentioned earlier in the call with that tax sale, gentleman owing money for taxes, and I'm trying to buy it for the payment of the taxes against the deed to get the deed. You know, that's where I'm at with it. So my strategy as an investor is to pursue when there isn't any obvious inventory on the market, find it, because you know and it's in this case tax sales and sheriff sales, and other auctions. A lot of people are putting their properties up for auction, and they're getting some crazy money at these auctions. I think that strategy of you know, buying at auction is probably, it sounds counterintuitive, because people tend to get that auction fever and bidding up properties well beyond their valuations. And I've seen a lot of that. And I think that hurts the market overall in terms of property valuations across the board. But tax sale properties, by the way, guys, is very administratively intense, but you can find some good deals out there. So if you look at those properties, you get the list from the county websites and all of that, and you do your Google drive-bys first, because there's no point in going someplace where you don't know. You do a Google drive-by first, then you do a real drive-by if it interests you, and if the numbers work, and then you go to the auctions. And in some cases, there's not enough people there to even bid on them, and you can get a good deal. In other cases, you know, they're packed. Like the last one I went to in Dauphin County here, had people there, and the one property that I wanted was deferred till the next auction. So, and that can happen. But I will, as a little tidbit, tell you this is what you see as the number of deficiency in a tax sale when you pull it from the county website. That number is not real.
Yeah.
Let me explain. When you go to the actual auction, there is an attorney sitting there that's representative of all the other properties that are there. Every property is represented by an attorney in a tax sale, and there's an attorney sitting there, and the sheriff will do something like announce the deficiency amount, say it's $20,000, and you know, and then ask if, you know, there are any bids. Well, the attorney that's there will interject and say something like, upset price is $10,000. So the bidding actually begins at 10,000 rather than 20,000. So that's something to look out for. And I would encourage you to, for any other reason, if you don't decide to actually do the legwork required to qualify properties, just go to the auction just to see what it's like and experience it, because you might find yourself interested in looking at that as an opportunity for acquiring properties. The market's not going to normalize, in my opinion, for at least the next 12 months. 6 to 12 months, we might start seeing some normalization of value, but I don't see that happening this year. And like you, I'm looking for inventory. I'm looking for something to buy. As long as my money is sitting in the bank, I'm not making any money. I'm losing money. So, and I think that's the attitude you have to have in running this type of a business. So, but I don't want to ramble, but that's just my comments.
Richard, you brought up a good point, and John can back me up on this. As a licensed agent, you see things a little bit differently. And once something hits the MLS, whether it's commercial, multi-investment, or residential, it's stale. It's old news. It's been sifted through the broker's pocket listings. It's been sifted through the agent's information. Everybody who wanted a good shot at this thing before it got listed already knew about it. And once it hits the MLS, it's all out for the public to see. And it's really old news. The name of the game for us as investors is to try and find these properties before they reach the market. And that's one of the things that Rick has kind of perfected by doing things where you're not dealing with the average seller. You're dealing with a list essentially that's published, or you find the list. But if you could find these opportunities, our first deal was a guy I sent a postcard to, and he would never have contacted me otherwise. But that's I think a good option to look at, Scott, is I showed you that app when we were down eating dinner a few months ago. That deal machine thing is fantastic.
Yeah,
you can skip trace people. You can get their contact information, email, phone numbers, even that house across the street from your parents. You know, you can find who owns it. If you find a place that's remotely interesting, you know, do some research, try and be the one to beat the agents to the punch, because you're really getting old information if it's out there. And there are some deals on the MLS, but people filter through them all the time. And John, do you have any investor clients that you work with out in Denver? What's the market like out that way?
Right now, everybody is holding, and we're already seeing, you know, days on markets going from 2 to 8. Offers per transaction are dropping from 10 to 5. Inventory's up like 50% over just 3-4 weeks ago. So I think everybody's just kind of now moving their chips into position. A couple of the investors that I do work with are in a hold pattern right now, anticipating a bunch of those foreclosures to start hitting once the moratoriums are lifted and such. So,
Yeah, I think right now, the one thing I'm starting to do is actually door knock.
Yeah.
Like I just got access to that property. So, crazy stories. I had a property I got off an auction, and the daughter of the guy who passed away squatted for the last 2 years essentially, and so I finally got access to that 2 weeks ago, and changed the locks and everything. And the way I found out it was vacant is a location scout for a TV show called my attorney and said, hey, we're trying to find out who owns this property because they want to film a TV show, and it's Amazon Films. And so I said, well, okay, well, yeah, if I can get in. He goes, well, they think that it's vacant. So I went there, and sure enough, the doors are kicked off. Turns out we think she was an informant for the police, and that's why they refused to serve the notice that was in place since, because it's an ejectment. And, I went and, finally started changing the locks this past weekend. And, the number of neighbors that came up to me and, oh, thank you, you got rid of them, and I started handing them my flyers and went down the street and said, hey, you get a chance to pick your neighbor, somebody, not only that, but if there's anybody else here that this is going to happen to, and I think there's a turn that's happening now where, with the moratorium being lifted, and them actually starting to serve people, that you are starting to see people who are, throwing their houses on the market now because they're trying to look for a way out. And so if you could find them before, they'll put it on MLS, but we're seeing it in Pittsburgh, the same thing, where I do some investing there as well. There's just the inventory's gone up drastically in the last 3 weeks. And, you're seeing the dropping 10K, dropping 10K, dropping 5K. But I think it's the same thing. Like people just, there are things that are going off the market, or being sold, but it's almost like there's this, maybe it is the moratorium, whatever, but it's like, it's kind of like in a stalemate right now, it seems.
You have more leverage off market too. When you're
Yeah.
dealing with an on market sale, you have people who've already committed a portion of that sale to agents, brokerages, anything out there. I mean, most residential sales in this part of Pennsylvania are between 5 and 6% of the sales price just to the agents. I mean, if you can lock up a property off market, you can save yourself and the seller a decent amount of cash. That's what Ryan's no longer on the call. He had to go into work, but his property was listed by an agent, and it was a 1-month listing just to see if they could get their top dollar. And it was a pretty high price, nothing that we would consider because it doesn't make the numbers work. But after a month, it dropped off market. So I called the guy. I said, hey, would you be interested in an off-market sale? We have someone who might be interested. Ryan would do an owner-occupant style multi-units, a 3-unit. And I said, look, I'll do all the paperwork. I'll do it for the minimum that my broker will allow me to charge, both sides, as a selling agent and buying agent, just to help Ryan out. And we're going to go under contract next week, and it's saving them almost 20 grand in commission. It's all about being creative, and that, that little bit is enough to make someone happy. They don't have to deal with the market or the showings. tenants all can stay in place. They're comfortable with Ryan. He wrote them a nice letter. I love the property. You did a great job keeping up with it. And they're like emotionally attached to him for an offer less than stuff they got when it was on market. And it's crazy how it works. I'm really looking forward to seeing the opportunities that are out there. But if you guys can find stuff before it gets public, that's where the real deal's made. And the money's really made when you buy, not when you sell. Scott, when you bought your place for $100,000, the one you just sold for $500,000, you didn't know it was going to be worth $500,000 when you bought it. But yeah, you made a lot of cash on the sale, but the real deal is how much you get it for. And that's the number that really matters. So, this is a great conversation, guys. I like all the bouncing back and forth. There was something I wanted to ask Brian, but I can't remember what it was.
I want to ask Scott if he listened to the August 5th Bigger Pockets episode with Rob Abasola, who's a tiny house guy and is just doing incredible stuff in tiny houses. So Scott, if you haven't listened to that yet or watched it.
But that is called Bigger Pockets?
Yeah, Bigger Pockets, yeah. This guy's building 300 some square foot tiny houses in some cases for like $200,000, which is nuts, but he's renting them out at state parks like out of Joshua Tree and just making incredible money. Now he's getting into the glam tinting.
Yeah, glamping.
Right? Glamping, yeah. So you would be really interested in that. It kind of opened my eyes a little bit.
Yeah, that's great. So he's dropping his tiny houses off at these parks and renting them out.
He's building them. They're stick built, ground up. Yeah, he's buying land and he's building.
Gotcha.
But he's expanding down into Gatlinburg and other places now.
Mm-hmm.
Really top end, like Instagram.
Sure.
Tiny
Absolutely.
houses, right?
Absolutely.
Yeah.
That's kind of what I'm looking to get into. My wife's an interior designer. She's done interior architecture. And so we're big into that kind of thing. But man, it's really cool. A-frames are going up. Making the best use of these tiny spaces, all about quality on the inside, because people aren't looking for these ginormous places anymore as far as short-term rentals go. They're just looking for a quick getaway, refresh their minds, and pop out. And people, if it's done really well, they'll pay that extra $50 a night to stay there. Long term, that's a pretty big deal. If you get 5 or 6 of them, you can pay a manager to actually be on site. You can pay a groundskeeper to be on site. You can pay somebody to turn them over, and you're just sitting there running the deal, right? So that's cool. I'm going to look into that. There's a couple people that I follow on YouTube that are doing some similar things, and it's out there. The question is when does the market become so saturated? Now, when is this thing no longer a trend? Is it a trend? Is it going to stay? Because with a tiny home, you're going to be hard pressed to resell and get your money back if you don't sell when the trend is there and when the market is there. So those are some of the things I'm wondering too. Is this a long-term thing, or is this something that you're doing, for the next 5 years, maybe 10 years, and just trying to make cash flow out of? So.
I think in the podcast, he built one and resold it for like 300 and some. That was just crazy money, just for a 300. It's a 2-story tiny home, but
wow.
Top of the line. Yeah. You have to.
If it's the location though too, like,
yeah.
Because if like Yosemite, if you've ever been to Yosemite, there's like, you go inside the park and stay there, and whatever, you got to book it like a year in advance. But there's also like small RV parks and things that are kind of outside that you can still get the yard to go into the park, and it's real easy to hop a bus and but the property around there is like so expensive because you're it's California, whatever, but like you probably put a house on there, a tiny house on there, and if it's within walking distance of that yard, then geez, it would make a killing, I would think.
Yeah. But even just this weekend, I was kind of taking Matt's ideas, and I was in North Carolina mountains looking around Lake Nantahala, where they send, there's some Olympic rafting stuff going on in Nantahala, NOC. And man, I was just looking for dilapidated places and writing down numbers, writing down mailbox numbers. And I came back looking them up on Zillow, trying to figure out all the information that's on there, then going to the tax records, going to QPublic. And I just got back yesterday. So I just already started those kinds of things. But thinking along those lines, it's all solid information. Like, how do I get them first? There's nothing in MLS, right? Like you're saying. So Rick, man, I would love to kind of pick your brain too on how you're doing it. And maybe we can have some combos offline too.
Yeah.
Just find out what you probably already shared with all these guys and I've just missed it. But I am looking forward to hearing some of the next conversations too.
That Deal Machine app, it costs a little bit each month, but if you're going to be putting any time into finding places, it will streamline your process. You know, I had got a membership a few years ago, and I didn't apply it because I could find all the same stuff through the MLS and the tax records. I felt like I was just paying for something I wasn't using. But during COVID, when I was outside going for a run in the development, I had Deal Machine up in my hand, and I'm sending postcards to every house that I pass down the street that looks like it could have some equity or some problems. I sent out 500 postcards in a week just by click, send, and you have a template. It pulls up their name. It has everything there. It's like $60 a month, and I think you pay 75 cents a postcard. But I got a slam dunk deal off of each mailing, and it's worth a little investment, and it's just so easy right there at cross references. It's called Deal Machine. Check it out. You know, it's worth its weight. You know, Rick, if you use it, you know what I mean.
Yeah, I use it as well. It's funny because I just got a message a couple days ago from a lady saying, "I'm not interested in selling my house. Stop sending me these postcards."
It's working.
Like, nope, you're getting another one.
Okay, well, you call me whenever you are ready to sell, because it's going to happen one day, right?
Yeah, that's what I said.
Send her some flowers.
We'll stop sending the mailers, but if you know, because I've heard the story of it's the 6th time that they see it before they're typically going to call you, and like what they find is that, you know, that you are their backup plan for years.
Yeah, that's good.
And you know, yeah, that's what they say. It takes about anywhere from 5 to 6 times. But
Your postcards on their refrigerator.
Yep. Realtors do the same thing, and they target neighborhoods with just sold listing cards and all this, and that works. However, it gets pretty, you know, I'm sure everybody has a Facebook feed, and you get bombarded with the latest and greatest, whoever's sponsoring an ad in your area. But it's just about being the guy that's there, being genuine and being straightforward. You never want to, you know, sugarcoat anything. You know, it's different when you're licensed because you have to watch the ethics rules and all that. You have to be totally upfront and disclose a lot of stuff, which actually works to your advantage because they have options with you. But I think, I mean, you're in a really good spot, Scott, to have options right now.
Mm-hmm.
And if you're locked up in all these different portfolios, it might be tough to get out. And to Rick's point, I think we're going to see a level off, but there's a consensus in this area, at least, that there's not going to be a 2008 level crash. It will be a slight, you know, recession. There's going to be a correction in the market. We can already see it based on how many listings are up, days on market. It's all trending. You know, we'll see a price stagnation, maybe a little bit of a dip, but we're not going to see things drop off because of the massive amounts of people out there like us who are getting ready to just, all right, let's take it. And as long as there's a demand, there will not be a recession. You know, it's not going to be a bad one. In the past, there was always this huge void. They had to get rid of this stuff.
There's another great Bigger Pockets. The one right after that's Ken McElroy, and he talks a lot about the shortage of entry-level housing in the country, and he's still buying, still going all in because with inflation and all the money they're pumping into the economy, he said there may be a little dip, but as far as he sees, and he's a smart guy, house prices are still going to keep going up. So, you know, Scott bought a house for $150 and sold it for $500. If he'd have bought it for $175 and sold it for $500, he'd still be pretty happy with that, right? So if the numbers work, if you've got cash flow and you're covering things and you got a cushion, there's no reason to not keep investing, because I'm convinced it's still got plenty of room to go up. But if you want to know how far it can go up, go across the border into Canada, or, you know, go to a major city. There's still plenty of room for housing to go up, and it's going to become much more a renter nation
Mhm.
That's what Ken McElroy gets into. And it's interesting. He also talks about how some of these tiny houses and Airbnb are really affecting market prices because investors like us can pay a lot more for a house than someone who wants to live in it, because we can short-term rent it, or we can do lease to own. We can goose that cash flow. You know, if you're buying to rent, you can pay more than a flipper. If you're buying to do lease to own, you can pay more than someone who's buying as a straight rental. And so, you know, I can buy a house off the MLS. And in fact, I looked at summer of the weekend, I'm looking at 4 more Thursday night, and I'll probably put an offer on something, but I know that on lease to own with my own money, I can make 20% first year cash flow. And if I leverage that house and they buy it in 5 years, I can make 30 to 40% return on my money. So if I can do that and I've got the money to do it, then why worry that the market's going to dip down 5 or 10%?
Mm-hmm.
Well, I
Brian,
think
have you done
yeah.
a lease to own? Have you secured and like followed a deal through with lease to own?
Yeah, I just did my first one. And moved to airline stewardess. She's moving in on August the 15th. If I didn't, and I bought that house from a wholesaler and I made a mistake. I rehabbed it. And on lease to own, you normally don't do a lot of rehabs. So I bought a house for 54. I put about 30 in it. So I'm at around 90. If she's in there 5 years before she buys, I'll double my money. I'll make 90,000 profit.
Great.
If I'm leveraging the house, though, I'm going to pull 80% out. So I only have about 25,000 in the house. So in 5 years, I'll make about 80 on my 25, which is about a 40% return.
Great.
Maybe it's a little less than that because I just found out I got to buy flood insurance, and that's $50 a month. So yeah, maybe I won't make 40%. Maybe I'll make 37 or something, 35, but still pretty darn good.
Oh, darn. 37. Yeah. It's
Yeah.
there's really, you know, Pittsburgh's a good market right now for that, because that's the price you're looking at these places. But yeah, they're that's kind of what I moved into, because I had straight rentals and I had a property that was losing money every month, and by lease optioning it, I'm actually cash flowing it 100 and something bucks now. So they're definitely willing to pay a little bit of a premium in the rent. So I'm 150 a month more than what Rentometer is saying for that area is what I rent it for. And so
and they take care of all the maintenance.
Yep. Yeah,
and you don't need a property manager.
Yeah, I haven't been there in a year, and I've talked to him twice. But just paying the rent on time.
So Matt, you should let Rick and I talk about that maybe at the next meeting. I'm the amateur, Rick's the professional. He's a black card guy. I didn't bite the bullet on that, but we're both doing it. And I've got some more money coming into my 401k, and if I can keep getting S&T Bank to give me loans, I hope to buy another 4 or 6 houses on lease to own in the next year and a half.
That's a great point. I'm taking notes here. Lease to own. We're trying to brainstorm and get at least some outside people to come and present a few minutes at the beginning, just so you guys get some diversity and talking to guys who do this for a living, whether they be lenders, bankers, title guys. I think the next one we're going to have a guy from the title company just to come in and explain closing, maybe a seller finance deal, how that looks, and to have some flexibility there in the beginning. And it gives some people time to tune in and introduce themselves. But Brian brought up a good point. If you guys have any specific subjects that you want discussed, we can do really anything. It's super flexible. But more importantly, I want to try and find a time that works for everyone. And I know guys like Moses and I, our schedule really doesn't exist, and trying to find a time that works is easier said than done. But as we move here through this COVID, who knows what's going to happen with this next transition. Would you guys prefer an evening time or daytime's work? We're all kind of entrepreneurs in our own way. what timing would work best as far as flexible timing okay for everyone if we do an evening?
Yeah, either or. This kind of the middle of the workday for me, but because I do have a W-2, but so I'm keeping an eye on on Slack, at the same time in case. Yeah, we're going through some compliance stuff right now, so.
I'm at work too, but I kind of like this. I can take a long lunch. It's not a big deal. I put in
Yeah,
9-10 hour days anyway. So
yeah,
it's evenings are tough just because I've got a lot going on.
yeah, this time worked good.
So the general consensus, you guys, Moses, John, or Scott, do you have anything? I think Peter's still on here too. Any other times work?
This is fine for me.
Yeah, lunch hour is good. This is great. Occasionally, I might have to jump off a little earlier than the 1 o'clock normal scheduled time, but lunch is good.
Awesome.
Might see me eating a chicken wing or something.
It's funny seeing what everybody has for lunch, but Wargo's out there. He's still getting into breakfast.
I'm getting breakfast soon.
The last thing I wanted to ask you before we kind of tool off here, we got just a few minutes. I'm in the process of really trying to create a database of people who are doing different, whether it be lenders, investors, the different kind of investors, agents, all these different things. But really more importantly, at one point, especially in the next year or so, I think one of the guys in the group, whether it's me or anybody on the screen or somebody who's not on the call, somebody's going to have a hellacious deal come across their desk and they're not going to be able to do it. And if there's a point, I know each of you, and I know some of you very well, and others we just met via these calls. But I'm just trying to pull interest. If there's a good deal out there, I gotta let this dog out before she lets herself onto the floor. If there's a really, really good opportunity out there that Aiden, can you put her on her leash, please? Would you guys have any interest in whether it be a group partner, a syndication, an investment through each of us, whether it be for funds or for just an ownership share or equity? Would there be any interest for the right deal in doing something with this group? If we could find a unit or a property or whatever the situation may be, would you guys be open to that conversation when the time came?
I'm open to it. Always willing to listen. It doesn't hurt to talk, right?
Yeah, for sure.
Be interested in hearing more information about the idea.
Awesome.
Absolutely.
How about you down there, Scott?
I love it. I love the conversation. I never like to close doors or burn bridges, so I'm always open.
Awesome. Yeah, I'm not sure what's coming, but we'll see what can happen here. I know Richard and I have been looking at 15, 20 unit plus buildings just because, the guys that we're talking to, we actually met with a guy the other night in Allentown who helped revitalize the city, and they're doing $15 to $20 million deals, and it's just a normal day for them. And he was very upfront and said, our parameters have X. If they don't meet these parameters, we don't do anything. And then we're just sitting there salivating like, that would work great for us. You're okay with a 15% return, but it's only a 12. That's still, really good for us to consider. So just kind of keeping the options open. I know you guys, are at all different experience levels, but that would be an awesome thing. If we have a group of resources, the other aspect long-term, the real money is in lending money, not necessarily the business of owning. But if you can get into a long-term lending position, you can make some pretty serious cash and not have any hands on real estate, if that's something anybody's interested in. But we'll see how things go. But
That's new territory for me.
same here, man. You just make a little money off a little loan, put a lien on something, and I've heard it's addicting. And a few Bigger Pockets podcasts have been on about it. The other thing, Brian, I'm not sure if you listened to it. They had a campground and RV talks. That was a pretty fantastic episode. These things are like cash machines.
Yeah.
home parks. I mean,
Is that the rookie podcast you're talking about? I heard that one.
both rookie and the
Yeah.
Yeah.
We've got a guy in our program that just bought a campground in Colorado. And yeah, he's living the life out there. In Colorado Springs, I think is where he's at. But
not too far from John. Long one.
Yep.
That's what I want, John. Let me know, because we need to buy something that's beautiful and fun and outdoorsy and just live there and live the dream.
Sounds good.
All right. Thanks, Phyllis.
All right, guys. See you around. Thanks again for everything. Appreciate it.
yeah,
This
thanks
is
for
great.
joining us.
Thanks,
Nice to meet
Scott, for your time. Appreciate it.
Enjoyed it, guys. Thank you.
you. We'll see you.